Hello and welcome to interest.co.nz. I'm Janae Tibshirani and today I'm talking insurance industry shake-ups with IAG's Government and Stakeholder Relations Manager, Bryce Davies. Thanks for coming in, Bryce.
Pleasure.
A major law reform is underway to change the way the Reserve Bank regulates insurance companies. The Prudential Supervisor is largely interested in making sure insurers have enough capital to survive another major earthquake or loss event of some sort. Currently, the Reserve Bank requires insurers to meet minimum solvency standards to maintain their licences. So, Bryce, at the moment in the Reserve Bank size, you either meet the solvency standard or you're seen to be in distress.
Yeah.
Is it really so binary?
No, I don't think so. No, the Reserve Bank, you're right, the Reserve Bank will require us to hold a minimum amount, and there's a standard for calculating that. But there's an expectation that each company will think about their business and their exposures and hold capital above that.
Sure.
So for IAG's point of view, our board has a view on how much risk we have as a business. They have a view about how much capital we need to hold, and so we hold capital in addition to that minimum. And then the Reserve Bank, if it sees fit, can impose some conditions on insurers to add even more capital, depending on what's actually happening within their business or within New Zealand. So there's layers to that capital, and I don't think it's as, although it might seem like it's kind of you're in distress or not.
Yeah.
There's a bit more to it than that.
Okay, the Reserve Bank has said, as it sort of looked to review the law, that it would like to consider taking a more graduated approach when it deals with solvency.
Yep.
So it's noted that the approach at the moment could be seen as a bit too binary in its words. Do you support a more graduated approach?
Well, I think there's two parts to that. I mean, they've talked about a more graduated approach in terms of being able to vary, say, that solvency standard by insurer or some of the methodologies. That's kind of interesting. I mean, I think the Reserve Bank, if they have concerns about an insurer's solvency position, they have tools available to them to actually ask them to hold more capital. And I think we'd want to be really clear about, well, what are the circumstances under which they would want to use an additional power? You know, when would you want to vary a standard for a particular insurer or not? So understanding what would be the circumstances under which that occurs, that's an important sort of thing. Which kind of goes to a bit of the transparency of the overall regime. So it's an interesting discussion to have, and I'm sure we'll have it as part of the review. The Reserve Bank's also talked about a more graduated response when they see changes in an insurer's solvency position, you know, allowing insurers, giving insurers a clear understanding of what their expectations are or how they might intervene as a solvency position deteriorates. I think that's a good idea.
Okay.
I think insurers want more clarity and a bit more certainty about how the bank views solvency and the sort of actions they're going to take. So
okay, sure. So if we just sort of go back to the first part of your response, which is the Reserve Bank's standards.
Yep.
Do you think it would be beneficial if you knew that at certain points the Reserve Bank might intervene and what it might do if it had some concerns about solvency standards?
Yeah, I mean, that's helpful. I mean, from IAG's point of view, we have a pretty good relationship with the Reserve Bank and we're talking all the time. I mean, as you expect, as you know, New Zealand's biggest general insurer, they are interested in our capital position.
Yeah, but if it was sort of a standardised thing,
if it was a standardised thing, that's fine. I think that just gives everyone a bit more certainty about what's happening. Okay,
and that transparency, you see scope for the Reserve Bank to be more transparent and
absolutely. And I think that's, I mean, for IAG, that's kind of one of the general kind of things we're looking for out of this review, just a greater level of certainty and transparency, not just in the solvency space, but across a whole range of areas within the regime.
Okay. In terms of that transparency, do you think it would also be beneficial if insurers were made to disclose more information to the Reserve Bank, so the Reserve Bank had more data that other insurers could see, so you could have transparency in the sense of sort of benchmarking against other insurance companies? Well,
it's interesting. When I've spent time in the banking industry and in the life insurance industry, and there is more data shared in each of those, and I think the Reserve Bank is looking at across those different sectors and trying to get a degree of consistency. More disclosure, yes. I think we're open to that discussion. I mean, I think a lot of the things that they're asking for, insurers already have. But we'd want to make sure that, again, we're very clear about what the requirements are.
Yeah.
So there's no kind of confusion about what they're actually asking us for, because I think there has been a bit of bedding down in some of the requirements so far in terms of understanding exactly what they're after and making sure that we can produce it. So certainty about what it is they're actually after is particularly important. But also, I think there needs to be a pretty strong use test with this information. You know, it's disclosure for disclosure's sake doesn't add anything. So as long as we're really clear about what it is that they're wanting disclosed and for whom and for what purpose,
okay,
then that's fine. No problem with that at all.
With the disclosure, you say that there's currently good disclosure in place. There's
some disclosure.
Disclosure in place. You know, if you compare New Zealand's regime when it comes to insurance regulation to other countries, you know, our system's pretty loose.
There's a lot less.
It's light touch, and IMF's raised that. So there seems like there's actually a scope for quite a lot more disclosure.
Oh yeah, I mean, I think what we produce versus what we would need to produce in other jurisdictions is quite a lot less, and inevitably we'll move towards more disclosure. I don't think that's up for debate. It's consistent with the Reserve Bank's regime.
Yeah.
It's a pretty low cost way of actually shoring up that regime. So I think it's absolutely on the table, and I think from here on in it's just a conversation about, well, what in particular they're looking for and why, and being clear about what it looks like when we produce it. For
a company like IAG, which is its parent is Australian based, would that actually be quite easy for IAG in New Zealand to disclose more information, given in Australia the disclosure regime is requirements are much more intense? Yeah. I mean, it should be. I mean, again, it comes down to what they're actually asking for, but I mean, obviously we need to feed up through our parent the information to support their disclosure requirements. I think a lot of the things that the Reserve Bank might point to, I think some of the examples are around, you know, governance standards and policies and information around directors and things like that were mentioned. Well, that's fine. We have those sorts of things. Any insurer with good governance arrangements would have that information, and it should be pretty easy to disclose. Just provide it. Okay, sure. Transparency being the key thing there once again. Okay, look, to go on to something else, Bryce, local incorporation is another thing that the Reserve Bank is tossing up. So at the moment, insurance companies can be either locally incorporated or they can operate as a branch. So IAG is locally incorporated. It's toying up, whether to require all companies to be locally incorporated, and the main reason is in case a company sort of goes under, then it needs to make sure that its New Zealand's customers are taken care of and are prioritised. What are your thoughts on requiring all companies in New Zealand to be locally incorporated? Whether we go as far as locally incorporated, I'm not quite sure. I don't get the sense that the bank has the appetite to go that far. For us, it comes down to, I guess, the issue of policyholder protection. And as you say, if an insurer gets into trouble, that the assets are there to meet the policyholder needs and they're not being whipped off somewhere else. So I think that's the important lens we need to put across that. But there are ways in which that can occur. Sure. You could make everyone locally incorporate. There's talk in the issues paper around statutory funds, which effectively ring-fence the assets. There's assets in New Zealand tests. There's other sorts of tools that would be available. Okay. So we're keen to have that conversation. Was there one that you were sort of leaning towards more in terms of providing that better policyholder protection? What about the assets test? Yeah, look, I mean, I think that's got to be the starting point. I think if we think about branches, you know, some of the exemptions that are available to them need to be looked at. If not the exemption, then the fact that they're actually given out. So one of the important ones there is that they can be exempted from the local solvency regime. And that just means that they're buying potentially less reinsurance and therefore less protection. So we think that needs to be looked at to make sure that actually, if you're writing businesses in New Zealand, you've got the assets sitting behind you to actually deliver on those promises. And then making sure that those assets are actually here and earmarked for New Zealanders. That's the other important thing. Okay. Yeah. And do you see a certain amount of that as sort of levelling the playing field? Because IAG is already doing that, it's required to, being locally incorporated. Do you see it as a competition issue? Not necessarily, no. I mean,
No, not really. I mean, I think for us it's more of a consumer issue. It's an issue that if a policyholder is taking out a policy in New Zealand, I mean, let's be real about this. Most New Zealanders don't read their insurance policy. They wouldn't know whether their insurer is a branch or locally incorporated. They wouldn't know that their insurer might have a policyholder preference to Australian policyholders and not New Zealand. So they don't know that sort of stuff. And it's probably unrealistic to expect that they're going to do that level of due diligence in making their decisions. So we've got to do that work for them. We've got to make sure that at least a minimum set of protections are in place so that no matter where they buy from, they've got the right level of protection.
Okay, and that level of protection, if we looked at that asset testing, do you think that will provide a lot more protection than the solvency standards provide for? Even so, say you had a locally incorporated company that met the solvency requirements, but then if we included sort of an asset test to it as well, you know, do you think that how much more would that strengthen the that company?
It's an interesting question. I don't know how much more, but I think it's an important element that you know, if an insurer ever gets into distress, someone's going to step in and try and manage their way out of that situation. They need to be able to get their hands on the assets to meet the policyholders. If those assets aren't in New Zealand or aren't legally owned by the New Zealand entity, or there's difficulty getting hold of them, then that's not protecting New Zealanders. Okay.
All right, Bryce. Well, thank you. I think that sort of touches on only a very small part, actually, of the Reserve Bank's review. But the significance, I guess, for consumers is having some more confidence in the insurance sector, which is important.
That's the ultimate aim.
But thanks for your time. Appreciate that. And I'm Janae Tibshirani from interest.co.nz.